back. We heard from Timothy Moore that Goldman Sachs has moved India to overweight, expecting 21,800 on the Nifty. But what about the economy in 2024? I have with me Shantanu Sengupta, Chief India Economist with Goldman Sachs. Shantanu, thank you very much. First up, the big number that will come out is the second quarter GDP. The governor has said it'll be better than the 6.5%. What's your number?
We have a slightly lower estimate than where consensus is. We are at sub 6% for growth for the second quarter, calendar year third. We think that it will be dragged down by mainly two factors. One, you had the uneven distribution of monsoons. Two, inflation was very high, which could pull down disposable incomes. We think that in the current quarter, that is the third quarter of the fiscal year, growth will rebound, helped by subsidies and transfer payments from the government, and also some bit of festive season consumption spending.
Okay, no, fair point. We'll hold you to that when the numbers come. But even for the full year, you are standing at 6.2% fiscal, whereas RBI, I think, is at 6.5%. Is there an upside risk, or do you think that 6.5 is too optimistic?
We think, in our view, the risks are more or less balanced around 6.2. I mean, sure, if you get a little bit of more impetus from government spending in the current quarter and in the next quarter, you could have growth pushing higher towards 6.5. Whereas, if you have more headwinds from consumption growth, and you've had consumer companies not reporting great numbers in terms of volume growth, etc., which is where we think the drag will be a little bit in the current year.
No, even I found it a little difficult to share the governor's exuberance, though some of the economists we called did think that there could be an upside risk. See, there is this further Reserve Bank move to tighten risk weights on consumer lending. Did that make you change the number? Will it have a macro impact, or is it too small?
We think it is too small from a macro point of view. I think the RBI was very judicious in increasing risk weights and hence increasing the price of loans in that segment, rather than increasing interest rates, which is a more overall impact on the economy. So more than the economy on aggregate, we think it is that segment which gets impacted. It was in any case growing at a very sharp clip. And therefore, as a regulator, probably you would want to slow that down a little bit.
No one faults the RBI. I think they got a lot of kudos for that. It was just, you don't think there's a macro impact?
Yeah, not at this stage. We do not think it's a macro impact unless there's a contagion. Okay. But the contagion is exactly what the RBI is trying to prevent against.
Stop the banks to NBFCs to consumer lending. Okay, the other thing about your report which intrigued me was the rupee. You're expecting an appreciation of the currency next year?
Yeah, so our view is, overall it's a flattish rupee. I think the near term we are expecting a little bit of depreciation because the dollar we think will be slightly stronger in the next 3 to 6 months, which takes it higher towards 84. But over the medium term, that is a 12-month horizon, look, our view is that the dollar will sort of peak out as the market starts pricing in Fed rate cuts in the second half of the year. And the reflection in the rupee is basically the dollar view. But overall, I would point out that, one of the parts of the macros, which is looking really stable for us, is the current account deficit. We think it's going to be around 2% of GDP or probably lesser. You're having these tailwinds from fixed income flows next year due to the bond inclusion. Equity markets, we have, raised to overweight. FDI, we think, will be tepid, which is what has been baked into our forecast, around maybe 1% of GDP. But overall, it looks like the current account will be well funded. And the RBI has been very active in terms of, keeping rupee range bound. And hence, the 12-month view is more a reflection on the dollar rather than the rupee leg of the currency.
No, I take your point. But, the Reserve Bank has had its own way. It has not allowed the rupee to depreciate when the dollar was strengthening. It came in on the other side. And now when the dollar has weakened, it's not allowing the rupee to strengthen because, it's allowing the pent-up depreciation, perhaps. Where I'm coming from is I'm just trying to play devil's advocate that the Reserve Bank seems to be in favor of a slightly depreciating currency. Plus, as you pointed out, FDI has been pretty weak all over the world and into India. Services exports, you also point out in your report, has peaked off. So isn't there a greater case for 83 to 84 rather than 81?
So 83 to 84 is happening in our near-term horizon.
Your first
Again,
half.
when the dollar, in our view, remains slightly stronger, as the market still tries to figure out what is happening in the dollar rates market or the Fed funds rate path. We think by the second half of the year, the market will be more convinced that the Fed is going into an easing cycle. We think it is going to be in Q4 of 24 calendar year. And that is when, in our view, the dollar peaks out and starts weakening, which is a reflection, therefore, coming in the INR view. And you would see that in all our forecasts across the Asian pack, the Asia FX is also appreciating.
Okay.
And in line with that, the INR is appreciating a little bit, probably other Asian FX more.
Okay. All right. I guess interest rate differential, everything will work in favor of EM currencies. Fair enough. Which brings me back to the Reserve Bank. What are your expectations in terms of inflation? Is it a 4-point something next year? Do we get at least closer to target? Rate cuts? What are the expectations?
No, so we do not think that we go to 4% next year. We think that we remain at...
Not even 4 point something.
Yeah, we think we remain close to 5%. In fact, in the current quarter itself, if you see what is happening with onion prices and now tomato, we think you go towards 6% on inflation headline. So we have a 5.7% forecast for the current quarter. We remain around 5.6, 5.7 for the first half of the next calendar year as well. And only in the second half, you'll have the base effect from the quarter gone by, which will drag it down towards 4. But our point is that there are these repeated food supply shocks, some of these oil supply shocks. The governor has alluded to that in his policy statement as well. Along with that, we think that WPI manufacturing inflation has already bottomed out and turned. And we have empirically found that that feeds into CPI core goods inflation with around a 6-month lag. And hence, we think that CPI core goods inflation will also bottom out and start inching higher maybe in the second half of next year, which therefore means that for us, core inflation is at around 4.5. With core around 4.5, it's very difficult to have a convincing view that you're going towards 4% on the headline, given the repeated shocks that you're seeing on food. Okay. And hence, our number is closer to 5% for the whole year.
So not much by way, how much of rate cuts and when? Does it happen in 24 at all?
We have a very shallow rate easing cycle baked into our forecasts. We think that there's 25 basis points of rate cut in Q4 of calendar year next year.
That Q4 is calendar. So September, October, November, December.
October, December of the next year. And then 25 more in Q1 of calendar year 25. So essentially, in the second half of the next fiscal year, you have 50 basis points of rate cut only, in our view. But I think more importantly, the RBI, given these repeated supply shocks, they remain hawkish. Liquidity remains tight, and therefore you have the overnight more closer to the MSF rather than the repo.
Okay. Well, let me come to the FY25 growth forecast. You have a 6.5. Do you expect private capex to pick up? Because clearly the government has to slow down its own capex because it has to bring down fiscal deficit.
Yeah, that's exactly right. Our view is that the government slows down the growth rate of its own capex. Our view also is that the second half, probably post the election uncertainty is over, you have a pickup in the private capex. Again, so this is something that we've been talking about for the last year.
But not much evidence is there.
But, from the supply side, at least, bank balance sheets look very well capitalized. The manufacturing sector balance sheets are deleveraged. There is this China +1 tailwind that is going on. And all of that makes us relatively optimistic that you can have a recovery on private capex in the second half. Remember also that, overall investments in India, when you look at GFCF, you have the government component, you have the private capex, and you have households. The households is driven more by the real estate cycle, which we think that the real estate cycle is on the way up. And combined with the real estate cycle and private sector capex, we think that investment growth in the second half can be relatively better.
Okay. Just a final question on, this potential for India. Does it remain at 6.5? Fitch made a strong point that potential growth in India and in many other countries is lower than what it was in the previous decade. Do you think it can continue at 6.5 or even better?
So firstly, we don't think potential growth for India right now is at 6.5. We think it's closer to 6%. Okay. But we think that by the end of this decade, if we are doing the right things in terms of especially investment growth and investment rate which is investment as a share of GDP, goes back to at least half of the previous peak levels, around, let's say, 34-35% of GDP, we think that can add about 50 basis points to potential growth. We can inch towards 6.5. So right now, if you see in our forecast, we have baked in, very early 6.1 as the potential growth. And yeah, we are not in the 6.5 camp yet, and we can get there if the right things are done on investments.
That's a sobering analysis, Shantanu. Thank you very much for that. Timothy Moore did point out that profit as a share of GDP is growing, and from 5%, it can go towards 8%.
Which is a great point, because empirically we have found that operating profit increases ultimately help in capex cycles on the private side. That's what you saw in the 2004 to 7 cycle.
Absolutely. Thank you very much for that, Shantanu. On that optimistic note that India will get to the 6.5% potential growth in this decade, and the Nifty itself in 12 months, 21,800. That's the Goldman Sachs view. Thank you very much for joining us on Indianomics.